Okay, we can go ahead and get started. Good afternoon, everyone. Welcome to the Understanding Insurance for Contractors workshop presented by the City of Los Angeles and Los Angeles Metro Contractor Development and Bonding Programs. My name is Carlos Ray. I'm the Program and Marketing Coordinator for the program. And we'd just like to thank you all for being here this evening. We have a great presentation for you this afternoon. And I have some housekeeping notes I want to get into before we actually get started. So the first thing is that if you notice, we're in our webinar feature. So how we submit our questions is through the Q&A feature of this webinar. And so you should see that if you're using a laptop, you should be able to see that. And we can answer your questions that way. You can submit them at any time, and we'll pause throughout the presentation to answer any questions and also leave time at the end. The chat feature is also available for use if there's comments you want to make or just to introduce yourself. We're also accepting that too as well. So just feel free to use both of those functions throughout today's presentation. The next thing is pretty important. It's a survey. So here's the link to the survey, and I'll make sure you guys all get that in the chat as well. This is for your feedback about how today's presentation went, and also helps us as we plan more programming options in the future and what we offer to you guys as far as things you want to learn, speakers you enjoyed. So please feel free to fill that out, and we will take your comments into consideration. And like I said, I'll put that in the chat so you're able to click on it and go right to that page. And lastly, this is how you contact us. So some of you may be members of the Contractor Development and Bonding Program. Some of you may not. This may be your first workshop with us. We're happy to have you, and we want you to learn more about our program, what we're able to do, and offer the services that we have. So feel free to contact us by phone or email, and visit our website as well to find out more information. And so with that, I will introduce our speaker for this afternoon, our CEO and leader here at Merriwether and Williams, Mrs. Ingrid Merriwether. So Ingrid, go ahead and take it away, and I'll get your presentation now.
Okay, thank you. Good afternoon, everyone. Thank you for joining us. I'm sure insurance education at 3 o'clock on Tuesday afternoon shows a lot of commitment by you. This is probably not perceived to be the most exciting topic, but I'll do my best to make it interesting, but most importantly, applicable to you as contractors. So just by way of a little bit of background, our firm is a property casualty insurance broker. Most of you know us from the programs that we administer for the city and Metro, and actually I can announce today, soon to be LA County will be joining the program. And we come at this from the perspective of trying to make what are normally barriers for contractors to participate in public construction projects, not there anymore. So bonding, insurance, some of the other technical content, maybe many of you have seen or participated in our events, is our effort at using kind of our knowledge and our expertise, if you will, in the insurance, bonding, risk management area in a way that benefits you as contractors, and again, kind of lowers some of those kind of systemic barriers that challenge you for participating in public construction. So today we're going to spend about an hour discussing insurance. And again, this is geared towards contractors. And as Carlos mentioned already, I really prefer if you all ask your questions as we go. I think it's a little bit easier for you to ask them in the moment of maybe the subject matter that I'm covering. And if you have a question, chances are others have a similar question. And so you're really actually helping with the overall education with the questions that you ask, because it helps really further the understanding for everybody. So with that, we'll get started. And Carlos, if you can advance the slide. Okay. Oh, you went one too many.
Oh, sorry.
Go back one. Okay. So, I want to really try to give you a practical understanding of insurance. As you all probably are already aware, it can be complicated, highly technical, a lot of acronyms. And I really want to start by encouraging you to look at your insurance program from the perspective of what is in your best interest. What do you need to protect your business? So often we see businesses, contractors, their insurance has kind of now become a compilation of meeting the requirements of everybody else. And when you do that, you're really designing your insurance program based on what others require of you, which really is about protecting their interests, not protecting your interest. So even though, of course, you have to meet insurance requirements of clients or prime contractors, my experience has been that if you develop a robust insurance program for yourself, as you should, in terms of protecting your business, 9 times out of 10, you'll meet the requirements of others. So that should really be the basis of how you develop your insurance program, with advice and consultation from your broker. But again, from the standpoint of what should you have in place in terms of coverages and limits to adequately protect your business and you, and then worry about meeting the requirements of others. Okay, so with that being said, we are going to kind of break these down into 3 categories. The first category is what we call first-party coverages. This essentially means you providing or purchasing insurance to cover your own stuff. This is about the physical assets of your business. Whether you own a building, obviously you're going to insure the building, the contents of the building. I mean, right now, we're all working in maybe different locations than what we're used to, which is something to be mindful about because things like property insurance are location specific. So if you've kind of moved out of a commercial space and have dispersed the contents that you normally have in your building in different locations, that's something that you need to contact your broker and communicate, because things like property insurance are location specific. So that's important to understand. The other thing that's important for you as contractors in particular is contractors' tools and equipment. And it's important for you to understand that you're going to treat those differently than you would your desk, your furnishings inside the office, for one key reason. Tools and equipment don't stay in one place. They're mobile. They're in your truck. They're in your garage. They're at a project site. They're in a laydown area. They're in a trailer. They're inside of a building under construction. If you don't separate out your tools and equipment and you lump them in with, your furniture and your office furnishings, they would only be covered for insurance when they're at that location. They would not be covered when you take them off those premises. So we'll talk a little bit more about that. But again, these first party coverages, as they're referred to, that's really meant you are the first party and it's you insuring your own stuff. Then we're going to talk about third-party coverages, and this is where it's heavily influenced by what is required of you. This is protecting your business from allegations brought by others who claim you were negligent in some way, and as a result of that, they have suffered some harm, specifically bodily injury or property damage. So this is the coverage that, say, a prime contractor or a project owner puts a lot of emphasis on, because they have what's called a vicarious liability when they hire you to perform work. Essentially, they could be sued in conjunction with the work you've performed if someone alleges you were negligent and that caused them bodily injury or property damage. So that's really protecting yourself from allegations of third parties, the public, for example, and is, again, where emphasis is placed by owners or prime contractors, because that's how they protect their vicarious liability in conjunction with retaining you for the work that you're performing. And then finally, workers' compensation. We won't spend a ton of time on that because most folks are pretty familiar with workers' compensation, but we'll talk about it a little bit. Next slide, please, Carlos. So here are the specific coverage types that we're going to talk about. So these represent, you know, the first party, the third party, the workers' comp that I just mentioned. Now we're going to start narrowing down on what specific policies fall under those categories. So we're going to talk about commercial general liability, as I said, workers' compensation, commercial auto liability, as I mentioned, that contractor's equipment floater covering your tools and equipment wherever it may be. We'll talk a little bit about professional liability. I don't know if we have anyone in the construction management space or architects and engineers, but that professional liability is really more geared towards folks that are in those kinds of arenas as far as construction is concerned. We'll talk a little bit about builder's risk. That's essentially property insurance for buildings under construction. And then we'll talk a little bit about OSIPs and CSIPs, which is a different approach in providing insurance for construction projects that's purchased by the owner or the prime contractor. Next slide. Okay, so commercial general liability. So the way a commercial general liability policy is structured, it's based on what limits of coverage you're going to purchase. Pretty standard, any contractual requirements you're going to have, say by a prime contractor, an owner, a landlord, a lender. These are all the entities who will require you to have general liability insurance in place, again, because of their view that they have some vicarious liability associated with you and your operations. So $1 million per occurrence is pretty standard. And then that, in addition to what's called the aggregate limit in your policy, typically it's $2 million. So you have $1 million for any one occurrence, and $2 million in aggregate, which means $2 million available during the entire policy period, which generally is going to be 12 months. But you can't have a loss for any one occurrence that exceeds $1 million. And so I want to talk about the importance of the word occurrence, because an occurrence oftentimes gets defined after the loss has occurred. And you may have a single loss that impacts more than one person, for example. And that entire loss or that entire incident that occurred might be considered one occurrence, even though you had multiple people who were injured, for example. So let's just say that some scaffolding that you constructed fell away from the building and down to the ground and injured, you know, several members of the public who were in the area. That is going to be considered one occurrence, even if 9 people were injured. So based on that, you want to understand that $1 million doesn't go very far. If you had a kind of catastrophic incident like that and multiple people were injured, chances are it's going to be greater than $1 million. So when you're thinking about how much insurance I should purchase, be aware of that. Then an occurrence can mean multiple parties who are injured or multiple properties that are damaged. Might be only one occurrence and you would only have $1 million. The other thing you'll find is commonplace with general liability is naming another party as an additional insured to your policy. So let's use an example that you're a subcontractor to Skanska on a metro project as example. And they're going to require you to have a general liability policy for no less than $1 million. It might be more than that. And they're going to require that you add them as an additional insured to your general liability policy. The purpose of that is that if they are named in a suit, a legal suit, that is prompted as a result of your alleged negligence for your work, they want to be protected under your policy. They don't even want to have to get their insurance company involved. So by adding prime contractors, the owner, a landlord, a lender, as an additional insured to your policy, it grants them coverage under your policy the same as you have coverage. The insurance company agrees by adding them that they will treat them as if they are their own entity, grant them a defense, pay settlements and judgments, just the same as if it were you under your policy. So that's the purpose of additional insured. Now, the composition of a general liability policy is made up of multiple coverages. So first and foremost is to understand that a general liability policy, its primary purpose is to respond to allegations of your negligence that cause someone bodily injury or property damage. That's it, not any other type of impact. Now, bodily injury does not just mean physical injury. It can include emotional injury, stress. It can include, for example, injury that is suffered by another party as a result of someone being injured. So I'll give you an example. Take that same loss that I gave you as an example where the scaffolding falls away from a building that you constructed, the scaffolding, and it injures multiple parties. And one party is seriously injured. Well, their spouse can also claim injury, even though they were nowhere near the incident that occurred, but they are impacted because their wife or their husband was injured. So the bodily injury caused to their spouse is now impacting them. They've lost their partner in terms of helping care for children. There's a term called loss of consortium. I'll let you all think about what that might mean. But so it is primarily bodily injury to someone, but it can extend to the consequences of that injury that impact others. Property damage is pretty straightforward, right? So the same scaffolding falls and it hits several cars and it damages them. That's property damage. So it's tangible property. Also within a general liability policy is product liability. Now, for the most part, contractors aren't considered manufacturers. You're not making a product. You're contributing to the construction of a building or infrastructure, whatever the case may be, but you're following specs and designs that someone else did. You didn't come up with the design or what's going to be built. So it's not considered a product. So for the most part, product liability isn't applicable to you. This would be, say, a food manufacturer or a car manufacturer. They're making products and they're liable for the performance of those products in the event they cause bodily injury or property damage. I'm probably maybe the only one in this age bracket who remembers that many years ago, the company Odwalla that made fresh squeezed juice, they're now owned by Coca-Cola, but probably 15 years ago, they had apple juice that was not processed properly, and a number of people got seriously sick and a couple of them died. So those claims against that company would have been covered under their product liability policy. Completed operations. Now that is very applicable to you as contractors. Completed operations essentially means your completed work. So if you are working on a construction project and let's say you are the roofer and you install the roof, you've completed it, it's been accepted by the owner, you've now closed out your contract, left that project site, moving on to other work, that work you left behind is now considered completed operations. And that's very important because the exposure for loss doesn't end when you finish and put the last nail in the roof or whatever fasteners are appropriate for roofing. It continues on because now that roof is expected to perform for at least 10 years. And if anything happens that is deemed to be a construction defect that occurred when you installed the roof, that has to be covered, even if it's 5 years after you completed the work. So for construction defect, the statute of limitations in the state of California is 10 years. That essentially means any construction that you participated in, you're responsible for any bodily injury or property damage that is caused by your negligence when you performed the work, even if it's many years after you completed the work. So that's very important that you as contractors have in place because that is inherent in what you do. Just to give you another very clear example of another type of business or industry that has a big completed operations exposure, think about mechanics, auto mechanics. You take your car to the mechanic, they replace your brakes. You leave the car lot or the mechanic's parking lot, you get out on the freeway and you go to put your brakes on and they don't work and you crash into a car. That is a completed operation by the mechanic. They are still responsible, and any bodily injury or property damage would have to fall under their coverage under their general liability policy. That's where you would sue them and get recovery from the bodily injury you suffered, as well as maybe the person that you ran into. So completed operations is really, really important for you as contractors. Personal injury. So those are allegations of libel, slander, defamation of character. So they're not physical injuries, but they're covered under your general liability policy. If you were speaking poorly about your competition, and if you were being untruthful in what you were saying, they could sue you for libel or slander because that's now impacting their reputation, that's impacting their business. And that would be covered under a general liability policy. And then advertising injury is basically false advertising, right? It's making claims that a product or service that you offer can perform in a certain way or do certain things that someone relies on. It's untrue. They sue you for false advertising. So for contractors, for the most part, we don't see this exposure occur very often. And then the last portion of a general liability policy is what we call medical payments. It's a very small limit of coverage, and it's kind of best described as like no fault insurance. So usually it's $5,000, sometimes it's as much as $10,000. So a very, very small limit of coverage. And it essentially allows for someone to recover from a minor injury that they believe you were responsible for. So someone comes into your business premises, slips and falls over an electrical cord, breaks their wrist. Essentially, you tell them, you know what, go to the doctor, get that taken care of, and just send me the bill. As long as it's under the limit of coverage that you have for medical payments, you would submit that to the insurance carrier and they would just pay it. No one needs to get an attorney. No one needs to sue you at that small dollar amount for something minor like that. The insurance company wants to just take care of it because if they can do that quickly, then the chances are that party won't go hire an attorney, in which case it's going to be a lot more than $5,000 or $10,000. Okay, next slide. I'll mention one more thing before I go on about I was saying how important the word occurrence means, and I'll give you a really good example that everyone will relate to. So all of us remember 9/11. And you remember there were, of course, two towers. The person who owned the two towers, the two twin towers, the World Trade Center in New York, was a wealthy gentleman who had just purchased those buildings and had just purchased his insurance for those buildings. Didn't even have the policies issued yet when 9/11 occurred. And so, as we all know, one tower was hit and came down, and then a few moments later, the second tower was hit and came down. So in the filing of the claim, his property insurance claim, because he now has two completely destroyed buildings, in the filing of his claim, there was an argument about whether or not that incident was one occurrence or two. The insurance company argued that it was one terrorist act. So therefore it was only one occurrence, which meant the policy would pay out just one single amount, the per occurrence limit. The policyholder and his attorneys argued, no, it was two occurrences. There were two planes. They hit two separate buildings, which if they were correct or deemed correct, then the policy would pay out twice as much. The difference was between $1 billion settlement and a $2 billion settlement. It took 3 years for that to work its way through the courts to define what an occurrence meant in that situation. Was it one single occurrence terrorist act, or was it two separate occurrences because it was two buildings hit by two separate planes? And ultimately the policyholder won. It was deemed two occurrences, and they got a check for $2 billion instead of $1 billion. So that's how important the word occurrence can mean. And you want to likely read your policy, read the definition of occurrence so you can understand that. Okay, so moving on, still under general liability, we're going to talk about how do you increase those limits. So as we said before, your primary general liability policy has limits of $1 million for any one occurrence. So the way you increase that limit, because maybe you're required to carry more, or in all honesty, you should be considering whether or not you carry more limits because that's protecting you and your business. You increase those limits through what's called an umbrella or an excess liability policy. They essentially mean the same thing. I prefer the term excess liability because umbrella liability sometimes implies that you're getting more coverage than you had before. Like there's this umbrella that's picking up coverage that you didn't already have. That's not really true. It's really excess liability. It's just increasing that $1 million to $2 million or $3 million or $4 million. Whatever you ultimately purchase, it's just adding more limits to your policy. And what I always encourage businesses to do is to always get quotes for more limits than you're currently maintaining so that you can make an informed decision. When people ask, well, how much should I buy in limits of insurance? The standard industry answer is as much as you can afford, because you really don't know what incident or what circumstances might happen. And it's always better to have more than you need than being short of what you need. The other thing about liability insurance is that the more you buy, the cheaper it gets. The first $1 million of coverage is going to be the most expensive portion of the premium you pay. The second $1 million in coverage might be only 50% of the first $1 million of coverage. The third $1 million of coverage might only be 25% of the first $1 million in coverage. So as you start stacking up limits, the cost of those additional limits are dramatically less than the first $1 million. So the only way you're really going to know is for you to ask your insurance provider, your broker, if you normally maintain $2 million, ask them, you know what, give me a quote for an additional $1 million or an additional $2 million. And then at least you're making an informed decision. Okay, I can afford the extra $600 to have another $1 million in liability. And trust me, if you have a catastrophic incident occur, you're going to work out much better being shy an extra $600 in premium if you have an extra $1 million in coverage. Okay, how is the pricing of general liability determined? How do they calculate what premium your particular business is going to pay? The first thing they're going to focus on is your loss history, right? So underwriters believe that the best predictor, the best indicator of how likely it is you will have a loss if they provide you a policy is what your history has been. And this is presented to them in what's called hard copy loss runs, some industry jargon that essentially means they don't take your word for it. You don't just submit something by email and say, I've never had a loss. Unfortunately, they're not going to accept that. So loss history has to actually be produced by the insurance carriers who have covered you for the last 3 to 5 years, depending on what they require. It has to be generated by them on their letterhead or their forms in order for the insurance company to accept it. And your broker takes care of that. Whenever you're possibly looking to move your coverage to a new carrier, your broker will get those hard copy loss runs and provide them. So that's the first thing they're going to focus on. And obviously, the more losses you have, the more likely is they're going to decline you as a risk, or they're going to charge you additional premium because of your history. So obviously, it's in your best interest to have good safety practices, good housekeeping practices on your project to avoid losses, because they do have consequences in terms of the insurance premiums that you're going to pay in the future. The other thing an underwriter is going to look at is, what is your scope of work? I mean, in construction, all trades are not equal in terms of risk. A contractor that's doing excavation, 10 feet down for Metro has much higher risk than a contractor who's coming in and painting the train station. So there's a wide range in construction in terms of the risk profile of a particular trade or a particular scope of work. The higher the risk is, the higher the premium rate is, quite naturally. And then once they make these first two determinations, then they apply the rate they've come up with to either your payroll or your gross receipts. Different companies use different bases. And that's how they determine the individual general liability rate or premium that you're going to pay. The other thing to understand about a general liability policy and the way it's constructed, a general liability policy says it covers everything. It says, essentially, we will indemnify you and provide you with defense for all allegations and lawsuits and claims brought against you, except for what is excluded. That is the design of a general liability policy. It covers everything except for what's excluded. So the most important thing for you then to understand is what is excluded on your general liability policy. Because if it's not excluded, it's covered. So I encourage you, reading through a complete general liability policy can be torture, certainly a cure for insomnia. And so if you want a shortcut route, just go straight to the exclusions in your general liability policy. Understand what's not covered. So that becomes something you avoid doing, or at least you understand that if you do engage in that, your insurance is not going to respond if you have a loss. And for contractors in particular, there will be exclusions placed on the policy that are kind of industry focused. So it's not uncommon for a contractor's general liability policy might exclude residential work in total. It might exclude townhomes and condominiums, more likely, very common, that townhomes and condominiums are excluded under a contractor's general liability policy. And the reason for that is that townhomes and condominiums, when there are losses, they're much larger losses. It's not one single family residence that has a roof leaking, and it's an entire townhome complex that has a roof leaking that has, 14 residents impacted. So it's not a single claim, it's 13 claims. Same thing with a condominium. So that's why insurance companies don't like to cover townhomes and condominiums. You want to understand how ambulance chasers even work in this arena. Attorneys keep track of new construction, townhomes and condominiums in particular, and they know when that development is nearing the statute of limitations for construction defect. And what they do is they send a very official letter to the association, the condo association, the townhome association, right, which is made up of generally unit owners who volunteer to be on the association board and take care of the responsibilities as far as the common areas of the condo and townhome. And they send them this letter saying, not sure if you're aware, but your townhome development is 9 months away from the statute of limitations for construction defect. If you, as the association, fail to file a claim for potential construction defect in your development, you can be personally liable. So they essentially create fear in the members of the association. Oh my goodness, we didn't know this. We can be personally liable if we fail to recognize there may be some construction defect issues with this townhome complex. So what they do is they send out a letter to all the townhome owners or all the condo owners and say, hey, the construction defect statute of limitation is about to expire in our building. Does anyone have any issues? Well, what do you think happens? People respond and say, yes, I have a crack here. I have something separating from the wall over here. And now all of a sudden we have multiple claims that was triggered by the attorney sending the letter to the association. So that's the kind of activity that insurance companies, find a little bit intolerable and why they don't want to cover these things. It doesn't mean you can't work on townhomes and condominiums. It means that the owner of those projects should be putting in place something called a wrap-up, which means they buy the insurance for the entire project and cover all the contractors that are performing on-site work. And then you don't have to worry about it because most owners know that your insurance is not going to cover townhomes and condominiums. Okay, next slide. Okay, so we're going to switch gears to workers' compensation. Of course, all of you as business owners know that this is mandated by law. You don't have an option. If you have employees, you have to have workers' compensation. Sometimes I talk to businesses and they say, well, I don't need it. It's my brother-in-law is helping me out. Or, my cousin comes and helps me out on the job site. Doesn't matter, relative or not, paid or not, anyone who's working on your behalf has to be covered by workers' compensation. So the limits of coverage are considered statutory by the state. Essentially, workers' comp is designed to cover an injured worker's medical expenses and lost wages. That's what the state statutory limits say. You have to provide for the injured worker's medical expenses and lost wages. That's what's covered. Now, in addition to that, there is a section of workers' compensation that's called employer's liability. This is what we call egregious negligence, where the employer knew of a hazardous condition that a worker could be seriously injured and did nothing about it. If that were to occur, then the injured worker could sue the employer and recover compensation above and beyond their medical expenses and lost wages. An example of this would be my father used to own a machine foundry and did metal adaptation. And it was kind of a joke because most of his employees were missing at least part of one finger. And so if my dad was failing to buy the protective equipment that goes along with the hazardous equipment that they use, that would be egregious negligence. He would know of a hazard and didn't put the proper safety equipment that would have protected injured workers. Workers' compensation, the premium that you pay is determined by 3 key things. Again, loss experience. So again, underwriters are focused on what's your history. In workers' compensation, that's even more formal because there's a rating bureau, the Workers' Comp Insurance Rating Bureau, that does a calculation of every California employer. It's called your EMR, your Experience Modification Rating. And it's kind of like a FICO score, but in this case, the lower the number, the better. And it's a formula based on the premium that you pay and your claims and losses, including reserve losses, the value of a loss that will occur over time. And they look at 3 years of history as part of this calculation that they do. And then through their analysis and the calculation, the formula, they come up with a number that is some relationship to 100. If it's above 100, that means you don't have good loss experience from a workers' comp standpoint, and it means you're going to pay more premium. So, you know, I've seen people who have an EMR of 140 or 150. Well, that means they're going to pay a 50% premium surcharge on top of their premium because of their losses. Conversely, someone who has loss experience of 90, they're actually going to get a 10% premium credit because they're considered to have good loss experience. So your EMR is a really critical number. In some instances, there are projects or primes who have a maximum EMR that they will allow for any subcontractor working on their projects. So if you let this get out of control, it can have a very detrimental impact in preventing you from accessing work or a dramatic increase in your cost of workers' comp coverage. So clearly, safety, safety, safety. This is where investing in a robust safety program to protect your workers, which you should be doing no matter what, but also benefits you by keeping your loss experience or your EMR as low as possible. The other thing that's factored into consideration is the classification of your employees. The job descriptions of what your employees are doing. Those are all fall into some type of classification. And just like your scope of work has ranges of risk, so do the work of your employees. So as a contractor, you might have employees who work in the office doing your compliance work, taking care of payroll. That's considered a lower risk. They're going to fall under clerical classification. You're going to pay the lowest rate for those employees. Your foreman is going to fall under a different rate. A worker that's doing underground excavation is going to be a higher rate than a worker who's painting. So each of your groups of employees are classified, and that determines a rate for each of those classifications. Then the last component is your actual payroll. So that rate for each employee classification is then applied to the payroll for those classifications. And that's how your workers' compensation premium is determined. So again, I can't emphasize how important safety is because the impact can be so dramatic on your workers' comp and on your business. A little bit about COVID. This is still pretty fluid right now, but for the most part, if you have workers who are working someplace other than from home, and if you're contractors, that's going to be the case most of the time, and they contract COVID, it's going to be presumed they contracted it at work. And this is essentially because, one, it's very difficult to determine where someone contracted COVID. Two, in the case of our firm, for example, all of our employees are working from home. So we really don't have an exposure for them to contract COVID at work because they're working from home. However, again, you as contractors, most of your workers are working out in the field on project sites. So if they contract COVID, you'd have to be able to prove that they didn't contract it while at work, and that's pretty difficult to prove the negative. So the one thing they did that I'm really pleased that they did to mitigate the impact of you having COVID infected employees being covered by workers' comp, they passed legislation just recently that said those will not factor into your loss experience. That won't be calculated as part of your EMR. As we all know, some people who get a serious case of COVID can be in the hospital for months, can be in intensive care. I mean, we're talking $300,000, $400,000, $500,000 medical bills. If you had one or two workers have an experience like that, it would throw your EMR so high that wouldn't be fair. So I'm glad to see that they passed legislation to say they're going to be excluded from your EMR calculation, even though their medical care and their lost wages are still going to be covered under your workers' compensation policy. So in summary, workers' comp is one of the most impactful insurance loadings in your bids. If you have good experience, good losses, it's going to give you a competitive advantage. Bad experience, bad losses is going to make it harder for you to compete. Okay, next slide. Uh-oh. Carlos, are you there? Oh, there we go. Okay. Commercial auto liability, I'll be really brief about this. The one thing I encourage you to do, if you haven't done this already, if you have a personal vehicle that's covered under personal auto insurance, but you're using it in the business, I really highly recommend that you sell that vehicle to the business. You can sell it to the business for $1 and then cover that vehicle under a commercial auto policy, not a personal auto policy. Personal auto policies do not contemplate that you are using your vehicle other than commuting back and forth to work, but that you're not using your vehicle in the course of business. So it's really important for you not to continue trying to have your commercial vehicle that you're using for work covered under your personal auto policy. This is also coverage that you can schedule your excess liability on top of to increase the limit. So just like I was talking about your general liability, when you buy an excess liability policy for say $2 million, you can also schedule your auto policy so that instead of $1 million of auto insurance, you'd have $3 million of auto insurance. So it's a very cost-effective way to increase both your general liability and your auto liability limits. It's important for you, obviously, to insure the vehicles that you own, but it's also important that you cover what are called non-owned and hired autos. So hired autos means you lease a vehicle, you rent a vehicle. That's what's called a hired auto. So that means your insurance would extend for liability only to those vehicles. And when I say liability only, it means that if you were rented a car, had an accident that you were at fault at, the damage or bodily injury you caused to someone else, that's what would be covered, not the damage to the rental car itself. But that's probably the thing that you're most concerned about is if you rent a car and you cause an accident that causes bodily injury or property damage. So that's what hired auto is. Non-owned autos, that's when your employees use their personal auto to drive on company business. So let's say you have an administrator in the office and he regularly runs errands for the business. He goes to the post office, he goes and picks up supplies, he goes and gets lunch. On one of these errands that he's running, he has an accident, a serious accident, and he's at fault. Maybe he was texting and driving and rear-ended someone going 40 miles an hour. Now you have individuals who are injured and you have someone's car that is damaged. They can bring a suit against you, even though you weren't driving the car, but you are the owner of the business and that employee was driving for the business at the time the accident occurred. If you don't have your auto insurance include non-owned auto, that would not be covered. You would just be left hanging if they sued the business. And if it's serious and they got an attorney, trust me, they're going to sue the business because you have much deeper pockets and more insurance than your employee did under their individual auto policy. So this is really important because all of us as business owners, on occasion, at minimum, have employees who drive their own cars on company business. And it's really affordable. I think you can have 35 employees covered for less than $400 a year. So it's a no-brainer. There's absolutely no reason for you not to have this added to your commercial auto policy. And then underwriting on auto, it's pretty straightforward. It's the value of the vehicles. It's the number of employees for non-owned. And then you should be aware that any drivers that you list, they're going to run DMV, MVRs. And if there is anything that concerns them, they will exclude those drivers. And they will not tell you why, because they have privacy protection they're responsible for, but they'll just say the following drivers are excluded. If they're excluded, it means they're not covered. You do not want those individuals driving company vehicles because if they have an accident, it's not going to be covered. Okay, next slide. Okay, I spoke briefly before about contractors' equipment floater. As I said, contractors' equipments and tools, which we know can be very expensive, should not be insured the same way you would your desk and furnishings because they don't stay put in one location. They're in various locations at different times. So you want to separate those out from all the rest of your business personal property and insure them under what's called a contractor's equipment floater, or sometimes it's called an inland marine policy, which kind of sounds like an oxymoron, but essentially inland marine means it's covered anywhere it is or anywhere it may be, except on the ocean. That's why it's called inland marine. So that's really important because, if you have an expensive piece of equipment and it's on a laydown site at a project, or it's in the back of your truck and it gets stolen or it gets damaged, it's got to be covered under this type of policy because it's not at your premises that covers the rest of your property. So that's very important. Next slide. Okay, very briefly on professional liability, it's also known as errors or omissions. And in construction, this would be applicable to someone providing some type of construction consulting or professional service like construction management, program management, architect, design, engineering. And so those are the most obvious cases where this type of coverage is needed, but that line sometimes gets blurry. And a contractor who doesn't normally do design or engineering will sometimes make adaptations in the field at the request of an owner that now they've crossed the line into being an engineer or an architect, because now you're providing consultation to the owner. So an example is you're building a structure and the staircase is designed by the architect to go in one particular location. And the owner comes to you and says, you know what, on second thought, I'd rather move the staircase to the other side of the building. And the proper response from you is said, oh, I'd be happy to do that. Can you please get me a new set of designs from the architect and I'll do that for you. Well, sometimes contractors say, no problem. I know how to shift that. I can take care of that. Well, you've just crossed the line. Because now if you put the stairs on the other side of the building and there was some engineering issue that you didn't take into consideration, maybe a loading issue, and now we have an insecure structure, you're going to be responsible. You will have caused financial harm to your client who now has these added costs to now address that issue. So that's what professional liability. Professional liability responds to financial losses that are caused by your error or omission. And so there are financial consequences. So just to give you a couple of points about professional liability and the way they differ from general liability. So one, you can buy professional liability for just a single project. So maybe you don't normally do any type of engineering or any type of design work, but you have that skill set. And here's a project where the owner would like you to do that and you want to do that. You can buy professional liability policy just for that particular project. And then that's, obviously more cost effective than buying it as a practice policy, which would be covering any and everything that you do. But the other thing to understand about a professional liability policy, it's what's called claims made. It means that whenever you let that policy expire, it expires retroactively from the first time you purchased it. It's as if you never bought it. So if you're an architect and you design buildings and you've been in business for 5 years, and in 5 years you've designed 80 buildings, and you decide, you know what, this professional liability, it just cost me too much money. I've never had a claim. I'm going to just let this lapse. I'm tired of paying this high premium. Well, then you just lost all the professional liability coverage you ever had on any building you ever designed. It just, poof, disappeared. So it's designed very different than general liability, which does not do that. General liability essentially stays in force for any claims brought against it attached to work that you did in any period of time. Not so with professional liability. So if you were an architect and you decided you didn't any longer want to be in business, you're going to do something else, there is a way for you to transition. You can buy what's called an extended reporting period that will give you coverage for the work you've already done in the past, but it wouldn't cover you for any future work. So just something to be aware of. Next slide. Builder's risk. So this is coverage for property damage to a structure that is under construction. And this has been a very active area lately where especially in housing projects, mixed use housing projects, they, for some reason, are suffering a lot of losses. Arson, targets for civil unrest, and buildings that are not yet complete are obviously more vulnerable than completed buildings. You don't have the sprinkler system installed. You don't have necessarily secured walls. You may just have really essentially a stack of timber by having a lot of frame without a lot of protection around it. So builder's risk covers the cost of damage or destruction to buildings that are under construction. And for most of you as contractors, it's likely that someone else will purchase this coverage. Usually the owner or the general contractor will purchase the builder's risk policy because it has to cover essentially everybody's interest. So what's important, if you're working on a project, you should find out who has the builder's risk policy. Get a copy of the certificate that evidences the builder's risk policy. It'll tell you who the policyholder is. It will tell you who the insurance company is, the effective date, how much coverage is in place. Because if you, for example, let's say that you are installing cabinets at a mixed-use 10-story high-rise building. Well, at any given time, you have cabinets that are there but not yet installed. You have cabinets that you've installed that you have not yet been paid for. If at that point in time, the building burns, you have a loss. You now have cabinets that you're responsible for. Maybe you've already paid for them that you haven't been paid for. Therefore, you have a claim under the builder's risk policy. So that's why it's important for you to know ahead of time, who has the builder's risk policy and am I covered? And the way that you're covered is that the named insured on the policy would read, Clark Construction Prime Contractor and subcontractors of every tier. That's what the policy or the certificate should say. And that's how you know you would have coverage in a situation like I described. Okay, next slide. This is pretty much more of what I was saying. Read the contract to find out who's responsible for the builder's risk policy. Also find out who's responsible for the deductible. Sometimes a prime will put the builder's risk policy in place, but will pass down a deductible to a subcontractor that they deem to be the responsible party for a loss. So if you're providing tradesmen that are doing some type of hazardous work, let's say welding, for example, and it is the sparks from welding that trigger the fire, the prime contractor may say, hey, it's your worker who caused this loss. You're responsible for the deductible. You need to know that up front because you want to make sure that you plan for the possibility that you're going to have to pay a deductible for a loss that you're determined to be responsible for. Okay, next slide. Okay, real quick, we're nearing the end here. So just a word about what are referred to as OSIPs, CSIPs, and wrap-ups. OSIP stands for Owner Controlled Insurance Program. A CSIP stands for Contractor Controlled Insurance Program. And a wrap-up is very similar. All of these essentially mean that a party purchased the insurance for the project and is extending that insurance to cover the contractors who are performing on-site work on that project. So it means, for example, your general liability policy is not responsible for covering you for that particular project. It's being covered by somebody else, the owner or the prime contractor. What you need to know if an OSIP or a CSIP is in place is what coverages are they providing. 90% of the time, they're going to provide general liability, they're going to provide builder's risk, and sometimes they'll even provide workers' compensation for your employees who are performing on-site work. There's an entity here in the Bay Area, BART. They do all their capital improvement programs with OSIPs in place, and they cover workers' compensation for all the workers working on their projects. I don't see that as often in Southern California. Even when one of these types of programs in place, and it would be very clear in the bid specs that this is in place, it's going to give you direction on how do you bid a project that has this in place. Obviously, you don't bid it the way you normally do because the project is providing for some or multiples of the insurance you would normally be required to provide, and you have to deduct for that. You don't want to include your insurance loading because they're providing the insurance for you. And if you still include your insurance loading, you might not be competitive because you failed to take that out. It's important to know that that coverage that is extended, let's say general liability, it only applies to on-site work. So if you're doing fabrication, for example, off-site and then bringing it on-site, it's not covering for the fabrication you've done elsewhere. They're also still going to require you to provide evidence that you have general liability or that you have workers' compensation for a couple reasons. One, They don't want a claim or loss you suffer on another project to somehow find its way on this policy. And that can happen if you don't have another policy in force to cover it. So they don't want that to happen. And then if you are performing work, some of which that's offsite, that wouldn't be covered under their policy. So you would need your own policy in place. Okay, next slide. Oh, it's before I move on, one thing also, read the specs very carefully, because again, they might be passing through a deductible to you for losses that you're deemed responsible for. So you need to know that, because that has a financial impact on you. So if one of these types of programs in place, you should be informed of the coverage limits and terms. Compare this to what you normally have. 9 times out of 10, it's going to be way more limits than you carry, and it's going to be much broader coverage, because they're insuring the whole project. So they use economies of scale to go out in the insurance marketplace, and they're able to negotiate the best coverage terms, much higher limits than you would normally maintain. So this is not usually an issue. There could be compliance requirements. You may have to submit different types of information about your insurance or payroll numbers. So just be aware of that, because they get very serious about you being in compliance with what's necessary to report. Sometimes they'll even hold back a progress payment if you're not staying on top of this. Next slide. I think we're getting near the end here. If workers' compensation is covered by the owner or the prime contractor in an OSIP or CSIP, even though your injured employees will be covered under the project workers' compensation, the losses and claims as a result of your injured employees still stay with you. They still get reported to the rating bureau under your employer ID. So you don't escape the impact on your EMR just because for that particular project, your injured worker was covered by another policy. That still stays with you. And that's important because they want to make sure that contractors don't come to the project site and just say, hell with all the safety we normally do. What do we care? The owner's providing the insurance. They don't want that, obviously. So they want you to understand that safety is still very critical. In fact, more than likely, they're going to have a project-specific safety program that you're going to be required to be in full compliance with. And the reason is, well, obviously, project safety is always important, but when an OSIP or a CSIP is in place, more than likely, they have a very large deductible in their program. It's generally going to be no less than $250,000 per occurrence. That's how these things make financial sense, is their ability to have really large deductibles. Well, obviously, they don't want to pay out those deductibles. So safety on the project becomes the utmost priority to them, and they expect you to fully comply with the safety requirements, because your failure to do so may mean they're paying a $250,000 deductible for a loss that you were responsible for. You don't want to be in that position. Next slide. Last slide. So if there's any questions, I don't see any in the Q&A. Carlos, I don't know if there's anything in the chat room, but that's actually the end of this kind of abbreviated version of insurance with respects to contractors, but happy to answer any questions.
Yes, please feel free to submit your questions. Thank you, Ingrid, so much for sharing that. It was some great information, and I actually learned a lot as well. So please feel free to submit your questions, and we can get to those.
And, you know, just as members of the program or as small contractors, just know that through the program, if you have issues arise related to insurance and need some help or some consultation, that's something that we're happy to extend to you. So you don't have to figure it all out at this moment. If something dawns on you later, or you're having an issue getting, an owner to accept your insurance or something like that, just know that we're a resource there to help you.
Yes, definitely. And you would want to make sure you contact your account managers and they can help you as well. So we just had one question come in, Ingrid.
Okay.
It says, how do we ensure we are covered if we purchase a project-specific E&O if it expires retroactively?
Very good question. So usually a professional liability policy or a project E&O, like you're saying, it has built into it the ability for you to extend the reporting period for premium so that you can still file claims related to that project after you've let the policy expire. So if you bought a project-specific E&O policy for, a building or whatever the case may be, when the work is complete, you're not likely going to want to continue paying the professional liability premium. So that is built into the policy that you can purchase an extended reporting period. And usually it's defined by time. You can buy a year or sometimes it's unlimited. And then you pay the premium for that. And then you know that you're covered for any claims resulting from the work you did on that particular project. So just read the policy. It's usually on the deck page that tells you how much that is. And you want to be aware of it because if you're charging that premium back to the owner, you're going to want to really account for the premium for the year you have the policy in force and the premium you're going to have to pay for that extended reporting period because they are all essentially tied to the work that you did on that one project. And that extended reporting premium can sometimes be 100% of the premium you paid while the policy was in effect. It's not cheap. And the reason why insurance companies require professional liability to be written this way is because this kind of work has what's called a long tail. You design a building in 2020, but the design defect isn't determined until 2026. And now the carrier is looking at a claim for a policy that they only had in force a year, 5 years ago. They're not collecting premium anymore. And now here's a $850,000 claim. So the exposures that have these kind of what are called long tails, where the consequence of your work can manifest in a claim many years later, they want to account for that. They need some extra premium in their reserves in the event that that claim produces itself down the road. That's why these are written on that basis.
All right, thank you. We have one more question.
Yeah.
If I want to be a service company for safety, insurance, bonding, OSHA programs, loan factoring, et cetera, what is the process?
Read that again, Carlos.
Okay, it says, if I want to be a service company for safety insurance, bonding, OSHA programs, loan factoring, et cetera, what is the process?
Okay, well, it almost sounds like you want to compete with us. So I may not want to help you a whole lot, just kidding. Well, I mean, the process to establishing a business that's providing all those services, starts with making sure that you and the people you bring on board have the expertise in all those areas. Doing safety consulting, for example, that's a high risk exposure. Safety consulting is very commonly part of kind of insurance brokerage services. So for example, we have full-time safety professionals on staff with our firm that do safety on construction projects. But they're very well paid, so it's an expensive endeavor. And two, that's a high risk because failure for them to execute their work in a way that prevents things from happening, construction incidents from happening, your business can be sued for negligence, and that can be a costly proposition. So I would, be mindful about that. Insurance services, I mean, that's, of course, you got to be a licensed insurance broker to get into the insurance business. It's not easy to do in a startup way. But, obviously it means getting licensed, and it means hiring people with the expertise. Insurance brokerage services is also something that's high risk, because we're providing expertise and consultation to clients on what kind of insurance they need, and our failure to properly counsel them or advise them exposes you to liability. So something else that you want to be mindful of. So, I mean, all those things are possible. But, I don't know if I would start a business offering all of those. I might pick one and then spread out to other arenas kind of after I got one in place and developed some expertise. And then, of course, get the proper insurance for the services that you're providing. Another reason to maybe only pick one of those areas to start, because you don't want to be paying insurance premium for 5 different service components before you're actually generating enough revenue in all of those areas. So again, you might want to focus in one area and then evolve from there.
All right. Yeah, she said that she didn't want to compete, but to partner with Merriwether. She looks like she took a class in 2018.
Okay.
Denise says, I'm an insurance broker in construction, bonds, etc. I've been in business using outside colleagues in this space for over 5 years.
Oh, okay. All right. Well, certainly reach out to us. Well, one thing that we do on a regular basis is refer contractors in our program to other brokers, because we don't actually, when it comes to bonding, we are actually not the broker for our contractors, because that would be a conflict of interest as we're administrator of these programs. So that's certainly one area of potential partnership, because some contractors come to us who aren't represented by a broker, and we have a list of them that we refer them out to. So you can follow up with Robert or Carlos or Lakeisha and Rick, all of team members who I see on the call today, to get more information about that.
Okay. Yep. Thank you. Do we have any more questions? I don't see any right here, so I think we are maybe good to end it here. Any last thoughts, Ingrid, or did anyone from the team want to share anything?
I have one last thought, and that's just to tell everybody to please vote. That's it for me.
Yeah, that's a good place to end it.
Okay.
And yes, Denise, we'll give you our contact information. I'll put it in the chat before we actually close the meeting. But if there are no more questions, thank you guys for attending. Have a great afternoon. Remember to vote and stay safe, and we'll see you next time. Thank you.
Thanks, everyone. Bye.